Welcome to the deep dive. We're here to give you that shortcut, to getting really well informed without drowning in research papers.
Exactly.
Today, we're plunging right into Innodata Inc. That's NASDAQ ticker INOD. And our mission really is to figure out if this company, Innodata, which has been around for like 35 years doing data engineering,
Yeah, long time.
has it actually become this essential digital pickaxe for the whole AI future? Or is this recent stock surge maybe more of a speculative fever dream?
It's a great question. And just for context for everyone listening, our analysis is based on everything up to July 26, 2025. The stock closed at $49.20 per share that day.
49.20. Okay.
And it really is a fascinating situation. You've got this established company right at the crossroads with bleeding edge AI.
Absolutely. And, here's the kicker right up front. This stock, it's a classic high-risk, high-reward play.
Definitely feels that way.
That share price, $49.20, it's actually bumping right up against the high end of an educational valuation model's bull case scenario.
Wow, okay.
So what that tells you immediately is the market. It's already baked in a lot of future success for Innodata, a significant amount.
Right, it sets a really high bar for them, doesn't it? They basically have to keep firing on all cylinders to justify that price.
Exactly. The market expects them to keep delivering quarter after quarter. So we're going to unpack what makes this company so compelling, but also why it's got investors so divided.
Yeah, let's get into it.
So if you're listening in, curious about all this, what does it mean for Innodata? What does it mean for how you understand this space? Let's figure it out together. Chapter 1, Business Understanding.
Okay, so fundamentally, Innodata is a global data engineering company. What they've done, very strategically, is position themselves as a critical partner for big companies building out generative AI and machine learning models.
So they're not building the AI itself.
No. Think of them as providing the crucial building blocks, the foundational stuff. They're the suppliers working behind the scenes.
Ah, the picks and shovels for the AI gold rush analogy. Makes sense.
Precisely.
And they have, three main business segments? How do those work?
That's right. Three distinct parts. The main one, the growth engine, and where their whole AI strategy pivots, is called Digital Data Solutions, or DDS.
DDS, good.
This is where they do data collection, data creation, really specialized annotation work, including things like reinforcement learning from human feedback, RLHF.
That's super important for tuning models, right?
Exactly. And this DDS segment, it's directly plugged into the spending pipeline of big tech AI projects. I mean, just look at Q1 2025. DDS brought in $50.8 million out of the company's total $58.3 million revenue.
Wow. Okay, so DDS is clearly the powerhouse driving this recent growth spurt. What about the other two? Are they significant?
They are, just different. The second is Synodex. This is very specialized. It's an AI platform specifically designed for the medical and insurance industries.
Oh, interesting. Niche.
Very niche. It takes messy, unstructured medical records and turns them into clean, structured data. You could almost think of it like a high-value SaaS solution for a very specific problem.
Okay. And the third?
The third is Agility. This is a platform mainly for marketing and PR folks. It helps with distributing content, monitoring media, analysis, that kind of thing. It's not really the AI growth driver, but it provides a nice, stable, recurring revenue stream. Kind of complements the more project-based DDS work.
So DDS is AI growth, Synodex is specialized AI for health, and Agility is stable recurring revenue in PR marketing.
Got it. It really sounds like their overall growth, especially from DDS, is tightly linked to how much the big tech firms are spending on AI R&D, like a symbiotic relationship.
It really is. Their fortunes rise and fall with the capital expenditure cycles of these massive tech companies.
Can you break down the specific services within DDS that make them so indispensable?
Sure. Beyond just annotation, they're deep into AI and ML model training. That means creating synthetic data, doing that super accurate RLHF annotation we mentioned. They also do a ton of data engineering, taking huge amounts of unstructured stuff like legal documents or research papers and making it structured, usable. Data curation too, cleaning up critical databases. And then there are those proprietary platforms, Synodex and Agility.
Right. Those offer very tailored solutions for their specific markets.
Now, there's still a small cap company, market cap around, $1.56 billion?
Yeah, roughly.
But they employ over 6,600 people globally? That's quite a workforce.
Yeah.
And the really striking thing is serving 5 of the magnificent 7 tech firms. That puts them in a pretty vital spot in the ecosystem, doesn't it?
It absolutely does. And their core value proposition, the thing they hang their hat on, is delivering exceptionally high-quality, accurate, complex data and doing it at massive scale.
Which is non-negotiable for AI.
Exactly. Bad data in, bad AI out. They achieve this quality using a hybrid approach. They call it human in the loop. It combines their own AI-powered tech with over 5,000 human subject matter
So
experts.
humans are still key.
Especially for tricky domains like healthcare or finance. You need that human judgment, that nuance where mistakes are costly. Their tech handles the scale, the humans ensure the quality and accuracy.
Right, so Innodata is sitting right at this nexus of data engineering and generative AI, especially since ChatGPT really lit a fire under this whole space. I mean, you hear analysts like Wedbush talking about a $2 trillion AI spending wave, the fourth industrial revolution.
Yeah, the hype is definitely there.
And the market for AI data annotation alone is forecast to grow like crazy, CAGR, of 34.4% to nearly $30 billion by 2033. That's a massive wave.
It is, and what's really interesting, reinforcing Innodata's position, is this growing focus on data-centric AI. Top AI researchers are saying, look, the quality of your data often matters more than the specific algorithm you use.
So it's not just more data, it's better data.
Precisely, and that plays right into Innodata's strengths, their focus on quality, accuracy, the human element. It validates their whole approach.
Makes sense. So how crowded is this space? Who are they competing against?
It's pretty fragmented, actually. You've got the big IT service giants like Accenture, Cognizant, who do a bit of everything. Then you have specialized AI data players like Scale AI or Appen. Interestingly, Innodata actually tried to buy Appen not too long ago, early 2024.
Oh, really? Didn't know that.
Yeah, the deal didn't go through, but it shows their ambition. And then you have other data processing firms. Innodata tries to stand out with its 35-year history, that deep domain expertise, and again, that hybrid human AI model.
You mentioned they weathered some serious regulatory heat recently. That sounds important. What happened there?
Yeah, that's critical context. Back in early 2024, some short sellers came out with reports alleging AI washing, basically saying Innodata was overstating its AI capabilities and even fraud.
Oof, that's serious.
Very serious. It triggered formal investigations by both the SEC and the Department of Justice that cast a big shadow over the stock for a while.
So what was the outcome?
Huge positive development. In June 2025, just recently, both the SEC and DOJ concluded their investigations without recommending any enforcement action.
Wow.
Yeah.
Okay, that's big.
Massive. It basically removed that huge regulatory risk cloud. There's still a related securities class action lawsuit pending, which is common after things like this, but the federal investigations closing cleanly was a major win for them.
Definitely reduces the uncertainty. What about barriers to entry? Could a startup just replicate what Innodata does?
It'd be tough, really tough. First, just the scale managing thousands of trained data experts globally, that's a huge operational challenge.
Yeah, I can imagine.
Second, building trust with these giant tech clients, that takes years, decades sometimes, of perfect execution. Proving your data security is ironclad. You don't just walk in and win a massive contract.
Right, relationships matter.
And third, Innodata has 35 years of proprietary tech and processes built up. That gives them an edge in efficiency and quality that's hard to copy overnight.
So their brand within this niche seems to be growing. Wedbush even put them on a list of key AI revolution companies alongside giants like NVIDIA.
Yeah, that Wedbush note gave them a lot of credibility, even if they aren't a household name like Accenture. And their cost structure, using global delivery centers in places like India, the Philippines, that helps them compete on price while maintaining scale.
Okay, so pulling that together, their competitive advantage seems to be this trust moat they've built with key clients.
I think that's a good way to put it. The switching costs for a major client are pretty high. Ripping out Innodata's integrated teams and platforms, that would be expensive, cause delays, risk data quality.
Create stickiness.
Exactly.
Yeah.
So that trust, combined with the hybrid model, their IP, and that client list, those are the core assets.
Chapter 2, Management Evaluation.
Okay, leadership. CEO Jack Abuhoff, he's a co-founder, strong background. His big achievement lately, successfully navigating that huge strategic pivot towards AI.
And he steered them through that rough patch in 2024 you mentioned. The short seller attacks, the investigations, that must have been intense.
Absolutely. That whole period was a massive stress test for management. The short reports, the lawsuit, the SEC and DOJ probes. Immense pressure. One research firm, J Capital, did criticize them for what they saw as delayed disclosure of the DOJ subpoena initially. But again, the decisive victory in June 2025, when both investigations closed cleanly, that really highlights management's resilience. They kept the ship steady, kept executing, and ultimately, the outcome validated their approach and their public statements.
So you'd say their ethical reputation came out stronger in the end.
I think you could argue that, yeah. The favorable investigation outcome definitely bolstered it. Their communication is generally pretty bullish, very detailed, though that historical disclosure point is part of the record.
And how are they using the company's money? Capital allocation.
It's all about growth right now, aggressive reinvestment. For 2025, they've said they're putting operating cash flow right back into enhancing their tech and hiring more sales and solutions people to fuel expansion.
Makes sense given the market opportunity.
Right. And they've shown they're open to M&A. They bought companies like Isogen and Mediamizer in the past. And that recent withdrawn bid for Appen, it shows they have an appetite for potentially big transformative deals if the price and fit are right.
And definitely no dividend or share buybacks recently.
Nope. Reinforces that focus, plows everything back into growth.
Which makes sense if they can earn a good return on it.
And that's the really striking part here, their return on invested capital, ROIC. The numbers are, frankly, exceptional. Morningstar has it at 75.28%. GrowFocus shows 92.84% for the trailing 12-month, 75.1% for 2024. Finimize even pegs the TTM ROIC at an incredible 263.98%.
Yeah, I mean, regardless of the exact figure, they are clearly generating extremely high returns on the capital they reinvest. It quantitatively justifies their strategy of retaining earnings rather than paying dividends or buying back stock. Why give cash back when you can earn that kind of return by putting it back to work in the business? Those are stellar numbers. Definitely points to effective management. Okay, let's dig into those financials more broadly. Chapter 3. Financial analysis.
Okay, financials. As we said, market cap around $1.56 billion as of late July 2025 puts them in that small cap category, higher growth potential, but definitely more volatility typically.
And the revenue growth. We touched on it, but let's look at the trend. It really shows that J-curve, that successful transformation.
Absolutely. Look at the numbers. Fiscal year 2020, revenue was $58.2 million. FY 2021, $68.9 million, up 18%. FY 2022, $79.0 million, up 15%. FY 2023, $86.8 million, up 10%. Then, boom.
Inflection point.
Right. FY 2024, revenue jumps to $170.5 million. That's 96% year-over-year growth.
96%.
And it didn't stop there. Q1 2025 revenue hit $58.3 million. That's 120% year-over-year growth for the quarter. This acceleration, this is the heart of the bull case. Management's even forecasting 40% plus growth for the full year 2025.
That's just explosive top-line growth. What about profitability? Margins.
That's the other part of the story, significant operating leverage. As revenue scales up, costs aren't rising nearly as fast, so more profit drops to the bottom line. Gross margin improved from around 34-36% historically to 39.4% in 2024. And their adjusted gross margin in Q1 25 was even higher at 43%.
Okay, and operating margin.
Huge jump. It was basically break-in, 0.3% in 2023. In 2024, it hit 14.3%.
Wow, and net margin. They were losing money before, right?
Yeah, they had net losses in 21 and 22, near break-even in 23. But in 2024, net margin hit 16.8%. And trailing 12 months, it's 17.5%. It's a dramatic profitability turnaround.
That's impressive leverage. What about cash flow? Are they burning cash to achieve this growth?
Not anymore. That's another key part of the turnaround. They went from negative or barely positive free cash flow, FCF, in previous years to generating a really solid $27.3 million in FCF in FY 2024.
So the business is now funding its own reinvestment.
Exactly. They're not reliant on external capital to fuel that growth, which is a much stronger position to be in.
Okay, so financially stable then. The historical inconsistency seems to be gone, at least for now. They've beaten earnings estimates recently.
Yeah, they beat consensus earnings per share, EPS, estimates in 3 of the last 4 quarters, so positive consistency is emerging. And that balance sheet still looks like a fortress.
Low debt.
Extremely low. Debt-to-equity ratio is just 0.09. Plus, they have an undrawn $30 million credit line available if needed. Plenty of liquidity, too. Current ratio is a healthy 2.36, backed by $56.6 million in cash on hand at the end of Q1 25.
Okay, solid foundation. So let's talk valuation again. That price-to-earnings PE ratio, it sounded high.
It is, relatively speaking. The current trailing 12 months PE is around 47.3. Depends slightly on the source, but it's in that ballpark, maybe 40 to 53. Compare that to some peers in related spaces. WEX Inc. at 19.9, Euronet Worldwide at 15.0, Maximus at 14.1.
So significantly higher.
Definitely. It's pricing in a lot of that future growth we've been talking about. The big question for any investor is, does Innodata's superior accelerating growth truly justify paying that much of a premium compared to others.
The market seems to think so, for now at least.
It does. It's betting heavily on the durability of that growth, especially with those big tech clients. It brings us right back to that core tension. Is this the digital pickaxe solidifying its essential role, or is it a speculative fever dream built on sky-high expectations?
Right. So if we try to pin down an intrinsic value using something like discounted cash flow, DCF, what
Yeah.
does that suggest?
Well, a DCF model tries to estimate a company's value today based on all the cash flow it's expected to generate in the future, discounted back at a rate reflecting risk. It's complex, involves a lot of assumptions.
Understood. But directionally, what does an educational model show?
An educational DCF model we looked at generate an estimated intrinsic value range. The base case came out around $34.77 per share.
Yeah.
The more optimistic bull case was estimated at $55.26 per share.
Okay, so $34.77 base, $55.26 bull. The current price of $49.20 is well above the base case and getting close to that bull case.
Exactly. And you have to realize the assumptions baked into those DCF numbers, especially the bull case, are very aggressive.
How aggressive?
The model assumes a 5-year revenue compound annual growth rate, CAGR, of 66.39% and a long-term perpetual growth rate after that of 12.68%. Those are incredibly high numbers to sustain.
Yeah, 66% growth for 5 years straight. That's
So it demands near perfect execution. Plus, the discount rate used, the weighted average cost of capital, or WACC, is also quite high, around 17% for the base case, 15.6% for the bull case. That reflects the stock's high volatility, its small cap nature, and the inherent risks. A higher discount rate means future earnings are worth less today, so you need even more growth to justify the current price.
So the DCF confirms the market is pricing in a very, very optimistic future.
That's the takeaway. Significant success is already reflected in that $49.20 share price.
Okay, we've got a solid grasp on the business, the management, the impressive financials, and the demanding valuation. Let's take a quick break. When we come back, we'll look at market sentiment, who owns the stock, and crucially, the risks involved. Stay tuned.
Welcome back to the Deep Dives look at Innodata. We've covered the core business and financials. Now let's shift to market perception and ownership. Chapter 4, Market Sentiment.
Okay, market sentiment. As you might guess from the growth story, Wall Street analysts are overwhelmingly positive.
Lots of buys.
Yeah, the consensus rating is buy or strong buy. The average one-year price target among analysts covering the stock is $65.69.
65.69, so quite a bit higher than the current $49.20.
Suggests significant potential upside, according to them. The range of targets is pretty wide, though, from about $55.55 on the low end to $78.75 on the high end. Recent updates from firms like BWS Financial, $74 target, and Wedbush, $58 target, have been quite bullish.
And that news about the DOJ and SEC investigations closing cleanly in June, that must have boosted sentiment quite a bit. Oh, absolutely. That was a huge positive catalyst. It removed a major overhang, a big source of uncertainty that had been dogging the stock since early 2024. You saw the media coverage turn much more favorable after that, focusing on the record earnings and the big tech wins.
Makes sense, but here's the contradiction. Despite all that positive analyst sentiment and news, the short interest is really high. Is at 15.32% of the float.
That's right. It's exceptionally high. It really makes Innodata a classic battleground stock.
So a real tug of war.
Exactly. You have the bulls laser focused on the incredible growth, the AI positioning, the profitability turnaround. Then you have the bears likely pointing to that premium valuation, the heavy reliance on just a few huge clients, and maybe the company's less impressive financial history before this recent surge.
And high short interest means potential for volatility. Maybe a short squeeze.
Definitely prone to high volatility. Any significant positive news could potentially trigger a short squeeze, where short sellers rush to buy shares to cover their positions, driving the price up rapidly. It adds another layer of complexity and potential fireworks.
What about the technical picture, moving averages?
Technically, it looks pretty strong right now. The price at $49.20 is above its 50-day moving average, which was around $45.63. That suggests good short-term momentum.
Yeah, long-term.
Also bullish. It's comfortably above the 200-day moving average of $42.51. So you have a situation where the fundamental turnaround story seems to be aligning with a positive technical picture, which traders often like to see.
Chapter 5. Ownership structure.
Okay, who actually owns Innodata? Well, there's significant institutional backing, which is generally seen as a positive sign.
Like big funds.
Exactly. Somewhere between 51% and 56% of the shares are held by institutions. BlackRock is the single largest holder, with about 6.3%. It's pretty broad support across many institutions, and there have been recent signs of accumulation by big names like D.E. Shaw, J.P. Morgan Chase, and Wellington Management.
So the smart money seems interested. What about insiders, management directors?
Insiders collectively own a pretty meaningful chunk, 12.2% really of the company. That's worth around $58 million, so they definitely have skin in the game. CEO Jack Abihoff himself holds about 3.7%.
That alignment is usually good to see. Any recent insider buying or selling?
Here it gets a bit more nuanced. There was significant net selling by directors, not the CEO, but other board members, totaling over 2.1 million shares. This happened mostly in February and March of 2025.
When the stock price was high.
Yeah, it was near the 52-week high around that time, so that's something investors definitely noticed.
But the CEO held his shares.
Crucially, yes. Jack Abihoff retained his substantial stake. And importantly, there have been no open market sales reported by any insiders in the most recent 3-month period leading up to our analysis date.
Okay, so director selling earlier in the year, but the CEO is holding, and things have been quiet more recently. How do you interpret that?
Well, director sales can happen for many reasons: diversification, personal financial planning, exercising options. It doesn't always signal a lack of faith. The fact the CEO held on and the selling stopped more recently might be seen as more indicative of current insider sentiment. But the earlier selling is still a data point bears might highlight.
So ownership is pretty balanced overall. Institutions, insiders, and the public.
Yeah, it seems relatively balanced. Institutions hold the majority, insiders have a decent stake, and the general public holds around 40%. All three groups play a role in how the stock trades.
Chapter 6, Risk Assessment.
All right, let's talk risk. Every investment has them. A quick SWOT analysis. Strengths, weaknesses, opportunities, threats can help frame it.
Okay, let's do it. Strengths.
We've covered many. 35-plus years of specialized data engineering expertise. Deep, growing relationships with those key Magnificent 7 clients. That scalable hybrid model combining AI tech and human experts. And of course, the strong balance sheet, minimal debt. High ROIC.
Makes sense. Weaknesses. What are the internal limitations?
The big one is that extreme revenue concentration. Top 5 clients making up 62% of revenue. That's a huge dependency. If even one major client pulls back or changes strategy.
Yeah, that could hurt badly.
Definitely. Other weaknesses. Compared to giants like Accenture, they're still relatively small in scale and brand recognition outside their niche. And there's that long history of inconsistent financial performance before the recent pivot. The turnaround is great, but the past provides context.
Okay. Opportunities. Where's the future upside?
Massive secular growth in the AI and data annotation markets. They're riding a huge wave. Potential to expand into new industries beyond tech, like healthcare and finance, where they already have Synodex. Developing new services, maybe around AI trust and safety, which is becoming critical for large language models, and potentially more strategic M&A to grow faster or add capabilities.
Sounds promising. And the flip side, threats, external challenges.
Intense competition is always there, from bigger players and specialized startups. That pending securities class action lawsuit, while maybe less threatening than the federal probes were, is still a potential cost and distraction. The rapid pace of technological change means they have to keep investing heavily just to stay relevant.
And you mentioned strategic capture risk.
Right. The risk that their development path or even pricing gets overly dictated by their very powerful clients. It could limit their independence or ability to innovate broadly.
What about broader economic factors? Is AI spending really immune to a downturn?
Management seems to think AI spending is relatively insulated, as it's seen as strategic. But a really severe recession could still hit R&D budgets eventually. And higher interest rates definitely hurt valuations for high-growth stocks, like Innodata makes future earnings less valuable today.
Any geopolitical risks, given their global workforce?
Yeah, relying heavily on talent in places like India, the Philippines, Sri Lanka exposes them to some risk. For example, purely hypothetically, if the U.S. were to impose tariffs on outsourced services someday, that could impact their cost structure or force them to raise prices. It's a background risk tied to their global model.
Chapter 7, Conclusion.
Okay, let's try to bring it all together.
Synthesize it for us.
The bull case. The reasons to be optimistic. Innodata has carved out a really strategic picks and shovels niche for the whole generative AI revolution. They've got explosive, accelerating revenue growth fueled by the biggest tech companies on the planet. They've achieved high profitability, strong margins, the amazing ROIC. They have a fortress-like balance sheet. And a major risk was removed when those DOJ-SEC investigations closed favorably.
A pretty compelling bull case.
It is. But the bear case has weight too. Concerns center on that premium valuation. There's very little room for error or slowing growth. There's that existential dependence on just a handful of big tech clients. Losing one could be catastrophic. There's the company's history of unprofitability prior to this recent run. And those director stock sales earlier in the year raise questions for some.
So definitely two sides to this coin.
Very much so. And tying it back to valuation one last time, our educational DCF model estimated intrinsic value between $34.77 in a base case and $55.26 in a bull case.
And the stock is trading at $49.20.
Right. So Innodata is clearly a high-risk, high-reward proposition. That current share price near the high end of the educational bull case implies the market has already priced in a tremendous amount of future success.
So significant downside if things don't go perfectly.
That's the risk. If growth slows down, if competition heats up more than expected, if those key client relationships fray, maybe because a client decides to bring more data work in-house, the stock could be vulnerable given its current valuation.
So what's the final takeaway?
Ultimately, whether Innodata is a good investment for you probably hinges on your conviction. How strongly do you believe in the durability of that trust moat they have with their major clients? How confident are you that they can sustain this truly extraordinary growth rate in a market that's incredibly competitive and changing super fast? It's a fascinating story, huge potential, but definitely not without significant risks and a demanding valuation.
Well, if you found this deep dive helpful, please do like this video and subscribe to the Stock Analytics AI YouTube channel. And remember, members can suggest stocks for future deep dives right there in the comments. We prioritize member suggestions.
Yeah, for just $4.99 a month, members get priority access to deep dives. We're actually planning to cover all of the S&P 500 stocks over the coming months, and members get that exclusive early look.
And if you just want a one-off deep dive on a specific company you're interested in, you can always drop us a super thanks.
And the important reminder. This analysis was generated by an AI system purely for educational purposes. It is absolutely not financial advice.
Please always do your own thorough research, or better yet, consult with a qualified financial advisor before making any investment decisions.
And just to leave you with something to think about.
Provocative thought.
Yeah. In this AI future, where the models themselves are getting incredibly sophisticated, how does Innodata ensure its human-in-the-loop model stays essential? How do they innovate that part of their business so their human expertise remains a true competitive advantage and doesn't eventually become, a bottleneck?
That's a great question. How do they keep the human element indispensable as the AI evolves? Something to definitely mull over. Thanks for joining us on the deep dive.